I'm head of our international business at the London Institute of Banking and Finance, and it's my pleasure to welcome everybody today to this first in a series of webinars looking at how alternative data is transforming SME lending. Before we get going, I've just got a kind of short introduction for you. We've got a little bit of a couple of points relating to housekeeping, just so everybody knows that this morning or today's webinar is going to be recorded, and that will include all the slides that are being presented. If you have any technical problems today, we're very aware that there is sort of unprecedented demand on Adobe Connect and other similar services. So my colleagues Annabelle and Liam are online, and they'll respond to any of your questions or queries in the chat box, which you can see alongside the slides. So just type in your messages there. Often a quick fix, a quick fix is simply just to log out and log straight back in, and that can often fix an audio problem. During the webinar, we will have a few polling questions, so be ready for those, as it's great to get your own thoughts and feedback. Also, at the end of the webinar session, we have about 10 minutes for questions. So again, during the webinar, if any specific questions come to mind, again, please just type those in the chat box. We will collate those. And then, as I say, we have about 10 minutes when Jonathan and myself will review those questions, which will be great. So one thing I just wanted to encourage everybody to do now, just to get used to using the chat box, is really just to tell everybody where you're coming from. I know we've got many people who've signed up for the webinar from many different parts of the world, and including different parts of the UK. We're all obviously adjusting to kind of new environments. I myself are based in Harpenden, which is about 25 miles north of London. It's I guess it's one of its most interesting features is we have the oldest agricultural research centre in the world based here, and indeed its founder helped to produce phosphates, which created the way for the mass production of fertilizers, which itself had a transformative effect on agricultural production. So in a way, we could perhaps try and draw some inspiration from that. In terms of the series itself, as I say, we're looking at how alternative data is transforming SME lending. I think one of the things that's obviously very clear in the front of everybody's mind at the moment is obviously the impact, the profound impact of COVID-19. And clearly we will be reflecting on this during the series. One of the points maybe just to think about is that it's acting as a catalyst to digitalize the economy, which is again acting as a real stimulus in many areas. One of the other things that's also very apparent is that SMEs or small businesses are the vital, essential to the growth of any economy. So again, ways that we can support the growth and meet the finance needs of SME businesses will be ever more important. And in a way, that's why we see it's very timely to be looking at this whole area of how alternative data models can support that. And if I may briefly, as you'll be aware, we've launched this webinar series in line with the launch of a new qualification that we have in SME lending and alternative data, which examines these areas. It's structured as e-learning and includes a number of regional case studies, so it's designed to be very practical and relevant. Okay, so that's just a bit about the series and the qualification. It's now my pleasure to introduce Jonathan Holman, someone I've known for several years now. He's Head of Digital Transformation at Santander across both their corporate and commercial bank. He is also an LIBF scholar and indeed has been a key contributor to the new qualification. So if I may, I'll hand over now to Jonathan. Thank you.
Thanks, Alistair, and good morning to everyone. I hope this finds you well this morning. I'm really excited to present my dissertation research, which I did for my master's as part of this presentation, which included an aspect of using alternative data in credit risk modeling. But we're also going to explore the history of credit risk modeling and the context in which evolving those models and using new data sources exists, and also how it is that perhaps with an emerging trend towards smaller businesses that are growing faster, modeling using alternative data sources is more important than ever, and things that one needs to factor in from traditional methods that focus on getting accurate models for SMEs. So the title of the presentation is "Can we predict the future?" And people might well say, given the frequency with which people are using the word unprecedented, no, we can't. Except I think if we think about that for more than just a second, maybe we can take a different a different answer to that question. Of course, we have got a precedent for the situation that we're experiencing at the moment. 100 years ago, Spanish flu swept across the world, and indeed we are making changes to the way we live our everyday lives in many countries, including my own, off the back of models where we are trying to predict the future. And you may be interested to know that the software that I used, the machine learning software I used in my dissertation, my research, which I'll present to you today, has also been used by Imperial College London in modelling how the outbreak of COVID-19 might go in the UK, and therefore what actions we should take in society, the economy, and in public health. So, without further ado, companies in most developing economies are getting smaller. Companies are growing faster, starting more often, and the impact and the effect of SMEs in the economy is larger than it's ever been. IPOs, initial public offerings of large companies, are in material decline. They've halved from the level that they were at in the mid-90s in the US and the UK, and more public companies are going bust than ever before. Private debt and private equity have grown rapidly since 2009, since the last financial crisis. And there are big examples like Airbnb and Uber who've raised billions of dollars in equity without the need to go public. There's been sovereign wealth funds, private equity firms, and hedge funds have all been in the market, as well as VC firms, bolstering the ability for technologically disruptive companies to grow very quickly and gain significant market share. Leveraging these businesses can help them achieve enhanced returns. In fact, 25 to 45% of private equity returns are based on the fact that they are leveraged, as in they have debt in their business, to achieve faster growth compared to those that don't. SMEs are well highlighted to have a funding gap, and around the world this is believed to be $4 billion and hundreds of millions in the UK alone. And mid-cap companies are under-levered. And in the UK, as well as in many other jurisdictions, banks are no longer the driving force behind SME lending. There's about 55 billion of gross lending that exists on bank books in the UK, and the net new lending from banks has been about 2.5 billion for the last 4 or 5 years. However, in that timescale, alternative lenders, peer-to-peer lenders, fintechs have emerged as competitors to the banks in that lending space, and they've now been lending 3 billion a year, outstripping the net new lending that banks have been doing into that space. So the question is how do we go about analysing these businesses and banks? Where does those techniques come from, and how can we improve upon them and take the lessons from academic studies that have been done in those areas to understand SMEs, to understand businesses, to predict whether or not businesses are going to perform well or going to default, and therefore we can decide how much we want to lend to them. And at this point, I'm going to initiate our first poll, which is to have some feedback from you and to have a think about how long you think the techniques that we use have been in place. So the poll should just be loading very shortly with Annabelle's assistance. And the question here is, how long do you think it's been since we've been using these quantitative analysis techniques that some of you may use in your jobs or in your academic studies. So the question is, when was the first recorded example of credit analysis techniques that use quantitative data? When do you think that was? How long do you think we've been using these techniques? I've got 150 of you here, so I'm going to wait a little bit more for the votes to come in. So more than 100 years, 80 or so years, 50 years, 30 or 40 years, where do you think? Okay, so it's pretty evenly split, although there is a bias towards the 1908 answer. And in fact, that's correct. 1908 is the first example. The first academic study we will look at in a moment is 1966, but the first recorded example was 1908. And we're going to take a look at that now. So William Rosendale put an article in the Bankers magazine in America called Credit Department Methods, and it was for a practical guide to banking. It was an assessment of ratios and financial analysis that one should consider about a company in order to assess their creditworthiness. And it was illustrated on a pro forma stating their assets and liabilities, stating their profitability, stating their longer term debt, and beginning to think about their prospects for the future. So very similar to the sort of analysis that we would do today. And I say this was more than 100 years ago. It even gave advice as to what a current ratio for a business, its current assets versus its current liabilities should be, which it said should be 2.5 to 1. Obviously, we don't achieve that in many leverage businesses or lots of businesses nowadays, but that was the advice given by this technique. But that was just one banker publishing their techniques in a magazine. 1966 with Beaver was the first recorded study of financial ratios being used as empirical predictors of future performance, the potential for default. And he managed to use a larger sample size and was able to predict very accurately for the first time using univariate analysis, using cash flow to total debt as a ratio, how many businesses would default within 1 year. And you can see he achieved 87% accuracy 1 year away from default. He also used the model to predict 5 years away from default and achieved an accuracy of 78%. 2 years later came probably the most famous study in this area, and Professor Edward Altman is someone who I've had the pleasure of working with during my dissertation research that I'm presenting to you today, and he invented the Z-score, and it was published in 1968. Now, he was the first person to use multivariate analysis and used a combination of ratios, including working capital to total assets, retained profit, taxes to assets, equity market value to book value, and sales versus total assets. And he gave each of those a weighting and was able to improve considerably on the accuracy of Beaver's study. 1 year away from default, was able to predict whether or not a company would go bust with a 95% accuracy. He also predicted 2 years, 3 years, and 5 years away, and you can see with decreasing accuracy. But the multivariate analysis really gave that significant uptick in performance and accuracy, the anticipation with which one could have of businesses going bust in the short term. Bloom in 1969 again used multivariate analysis, and although got similar results 1 year away from default, was able to double the performance of the model that Edward Altman had been able to achieve 5 years away from default. Again, he used 5 or 6 ratios with different combinations and different weightings and pieced them together to create a model that gave a score that on a scale could predict whether or not a business would go into default. And Edmiston started to now apply these techniques to smaller businesses. As you'd heard in Altman's technique, he was using equity market value and therefore sort of public companies and their value against their book value, whereas that wouldn't be true for small businesses. And Edmiston looked to try and apply the same tests, same techniques to smaller businesses. So he was using multi-discriminant analysis with multiple variants, using multiple ratios. But he found that unlike with larger companies where 1 year's worth of data, only 1 year's worth of historic financials was good enough to predict the future and anticipate 1 or 3 or 5 years out from those particular points in time year. With smaller companies with more volatile performance, you needed a 3-year trend and a mean of that trend with which to then predict the future of that business, because 1 year the performance would be so volatile that it couldn't necessarily give you an accurate indication of the skill of the management and the strength of that business. So those are the main quantitative pieces of analysis, and we're now going to move on to look at non-quantitative techniques that used qualitative analysis in their studies. But at this point, we're going to do our second poll. So hopefully we'll be able to bring that on screen. The question is, Edward Altman using his multivariate analysis for the first time and achieving that 95% accuracy 1 year away from default, he built that original Z-score using only companies in the manufacturing sector. And he used companies that had gone bust as well as companies that hadn't gone bust and paired them with similar asset sizes. But how many pairs of companies overall do you think he used to build that model that had a 95% accuracy? Bear in mind that model's been in use for more than 50 years now, has accurately predicted us through 4 or 5 recessions, and is still being used today. I'll also give you another bit of context here. In my study building a machine learning based probability of default model, I used 200,000 company records. Obviously the scale of big data nowadays and computing power makes even a more amateur academic study I would put myself in the category of doing far more significant in terms of scale than what Ed Altman was able to achieve in 1968. Okay, so 96 pairs coming out on top, second 150 pairs, and third 33. In fact, it was just 33 pairs of companies, so 66 companies that he built this model on. So very few data points in the model, but yet he was able to achieve that accuracy by using that multivariate analysis and bringing in multiple ratios into the model. But in 1976, Argenti kicked off a change in focus. Sorry, some of these bits aren't coming up. Kicked off a change in focus in the analysis of companies by starting using subjective assessments of qualitative things. He looked at indicators that would help us understand whether or not a management team was good or bad, and how they were anticipating events in future and how they'd react to them. And that was more important than looking at backward-looking financials, which of course all the ratio and quantitative techniques did. And that theme of whether or not we're looking forward or whether or not we're looking backwards is key in alternative data techniques and is key to the way that evolution of these models and these techniques have happened. So Argenti invented something called the A-score, and he was looking at understanding the management skill and experience to be able to deal with any problems that the business might face. He said that the financial statements were the symptoms of management and their ability rather than the cause, and management skill and experience was going to be your best indicator for the performance of the business in the future. In 1984, von Stein and Ziegler moved these techniques on, and they were building models simply on management behavior and previous experience, and they were able to predict with 78% accuracy 2 years away from default whether or not our business would go bust purely on those subjective measures rather than using financial data. In 1987, Kesey and Watson built on Argenti's work and started exploring this in small businesses, just like Edminster had taken the quantitative techniques into SMEs. And they were able to predict with 83% accuracy, using purely non-financial data, what the performance of a business would be in a year's time. And then come 2007, Edward Altman, now a much esteemed professor, and the Z-score had been public in use for many years, worked with someone called Gabriel Sabato, and they demonstrated that banks in their 2007 study should separate SMEs from large corporates when setting their credit risk strategies and their models. And that's because they were building in both subjective analysis of the business, not qualitative techniques of understanding a management team's skill and experience, with those trended ratio techniques from previous studies. And in 2010, they were able to do that at real scale. The computing power was coming online, and the ability to access great streams of data from many companies over many years helped them produce a better model. So they used 5.8 million SMEs to produce their most accurate model in that space, which had 80% accuracy 1 year away from default, and that was a 13% increase from anything they've been able to achieve previously. And then in 2015, a chap called Blanco, he used purely non-financial data to be able to predict the performance of companies, and had a model that produced an 83% accuracy, which is the most accurate one that's been produced without financial data to this point. What his study particularly showed was the board experience, the experience of previous companies, and whether or not they'd failed, and the ratio of men to women, for example, on the boards of companies, were all interesting and useful factors in predicting the future performance of a company. So various studies established the importance of using quantitative data, and then after that, qualitative data built into those models, or even in isolation, could be used to help improve the accuracy of models. But from 1990, computing power, big data, and machine learning techniques, including neural networks, have been able to be applied to these data sets, run them more at scale, and have been able to improve without introducing more data sets. They've been able to improve the accuracy of predictive models. So simply by applying a neural net as the statistical basis for calculating how a model will perform, rather than using univariate or multivariate analysis that have been used in the past, you normally saw about a 3% improvement in the performance of the model in its predictive outcomes, so fairly significant, its accuracy of its predictive outcomes, just by applying those improved statistical techniques. For SMEs, this tends to get even more stark, where because of the way that neural networks can decide on idiosyncrasies that apply to SMEs, particular industries, they've been able to improve the accuracy of some models by 12 to 30%, because they're able to take into account more subtle factors that are smoothed out by less sophisticated and less nuanced statistical techniques. And the other thing that lots of models have been able to take into account, which are used now in many banks' credit models, are subjective assessments beyond the qualitative and quantitative data, to give the sense of a business's position in the market, and rank that on a scale, or the skill or competence of a management team, and give a sort of wisdom of crowds effect to judging these things that are quite hard to otherwise qualify. And they've been fed into models. And again, neural networks and machine learning have helped build those in to improve the accuracy of those. Now, when thinking about social data, data that represents society, how it's behaving, how it's thinking, we have a number of sources we could now draw upon. Social media, we could have a look at business sites where things are reviewed, like Yelp or Google reviews. But we also have search engine queries, where we're fortunate enough to have access to data where people type basically everything they think and feel they put into a search engine, including things that they worry about for the future, things they want to understand about the past, things that they are feeling physically, things they're thinking about in terms of their job, things they want to get better at, things they want to study, things they want to buy. And since 2009, people have been using the data from Google Trends, as the largest search engine in the Western world, to be able to predict the events of the future in various sectors, in various industries, in various social scenarios. And in fact, very relevant to today, the first study was done by a chap called Ginsberg, working with Google themselves. And this study in 2009 was helping to predict an influenza outbreak, a normal influenza outbreak, shall we say, within a sort of metropolitan area and how it might spread to surrounding towns. And that was done by looking for people searching for cold and flu remedies and cold and flu symptoms on a sort of geographic time basis, spreading out from the epicenter of where an outbreak might occur, and being able to anticipate where medical centers or pharmacies would see an uptick in people coming in to use their services because they'd indeed contracted that strain of influenza. And they were able to anticipate that very accurately using Google searches from those areas. And it gave them a 2-week lead time for the demand on the pharmaceutical and medical services ahead of the disease outbreak actually happening. Now, in other countries, people have been starting to look at more commercial aspects of how this data could be applied. Hopefully this will come up. In 2017, Van Dijk in the Netherlands looked at using internet search history and the rate at which people clicked on particular properties and particular areas on a housing market real estate website in Holland that was very popular, to be able to predict the liquidity and prices of those houses. And they did find that liquidity in the housing market, how many properties were being purchased, how much would be lent, could be very accurately predicted, but they were less able to predict the actual house price movements from what people were doing on those websites. In 2016, Gunter took a look at trying to predict tourism demand and how much people might be traveling to a particular city. And they used one city, Vienna in Austria. They used 2 keywords being searched on Google, one Vienna in English and 2 Venn, the German for name for the same city. And they were able to try and predict hotel demand, flight demand, and other tourist destination sort of event demand within the city over a holiday period. And this was more accurate than anything they'd been able to previously do in this space. This industry hadn't seen a model that had been able to predict so accurately. They had sort of more than 95% accuracy with the predicting particularly flight and hotel demand. And this was based just on people searching for those keywords, Vienna and Venn, in Google, and being able to anticipate how much in advance that would mean that you would see an uptick or indeed a decrease in the demand for hotels in that city. Other people have begun to use Google search trends to anticipate more fundamental things like unemployment and benefits in a particular economy. This study, which was in 2009, started looking at correlations in the German economy between what people would search for, what they were scared of. Am I going to be made redundant? You know, the strength of a business, what's unemployment benefits like, searching for job sites. All these keywords that people might search for were indicators that people had concerns about their job. Maybe there'd be more churn in the economy, and therefore you could anticipate unemployment and benefit demand off the back of that. Budinsky in 2009 as well started looking at people anticipating the news stories of tomorrow based on searches that were today, and this was found to be more than 80% accurate from 1 day out, so you could predict tomorrow's news with 80% accuracy. In 7 days' time, you could predict headlines with 60% accuracy, the topics that would make the news based on search activity that was happening today. And then Molnar in 2017 started looking at gasoline prices in America and found that you could predict 6 months out what the gasoline price would be, although you couldn't do it too accurately. You could do it sort of 60-70% accuracy. You could give a general ballpark of where the gasoline price was going to be and anticipate demand, as well as what supply would have an effect on the price on the forecourt. And then in 2012, the Bank of England in the UK started looking at using internet search history data in predicting inflation and predicting demand in the economy, including the housing market, and being able to understand that to build a picture of the UK economy. Now, these are actually used by France in predicting unemployment benefit rates now. America use Google search history trends and data from that in building models for their economy, and the Bank of England have been using this data in their economic models since this time. However, their paper in 2012 concluded with a very sort of understated English verdict. They said, even in their current form, initial results suggest this data could be quite useful, but they wouldn't go beyond that, just quite useful. However, they say they are using it to predict house prices, inflation, and macro trends that would affect the economy. Now, your first thought might be, well, if we can predict the future using people, what people are thinking, what they're searching for online, then surely financial services must have been considered. And indeed they have. There have been more than 10 academic papers written on the subject. And of course, the first thing that people want to do is try and make money off the back of this. And the best way that people think to do that is to use this search history to try and understand what might happen in the stock market. And so predicting share prices, the volume, or indeed M&A activity that might happen using Google Trends search history is something that has been considered. And it was popularized by a TED talk that a chap called Tobias Pred did about his work, his academic research in the space. And he's written more than 3 subjects. What's been found generally is that Twitter sentiment and other sentiment is quite hard to decipher on the internet about companies compared to their stocks, because people type a lot about products, good and bad, all the time, and it doesn't necessarily reflect the results of the company. In America, where people have 401ks and they tend to invest their own pensions, you can get a more accurate prediction of movements in a stock price, not necessarily the direction of the movement, whether it's going to go up or down, but you can anticipate movement by looking at the search history for the stock ticker. So the ticker for the company tends to be a search that's correlated with a movement in the share price. People are anticipating it's going to go up or down, but you can't necessarily predict very accurately which way it's going to go, just that it will move. And so that's something that hedge funds have been using when they can predict and gamble just on a movement on the volatility of its share price rather than perhaps the price itself. But it's interesting that often human psychology begins to take an effect here, and when you're dealing with social data, that you can't ignore the sort of human brain and how it's processing and emotionally feeling about any one given situation and how that factors in. And that's certainly true with share prices, in that share prices are more likely to go down when there's an uptick in searches for a particular company. And also that's really highly correlated with Wikipedia visits. Particularly, you can trace Wikipedia visits to companies' pages on that online encyclopedia at the time just before the stock price decreases. And loss aversion means that people search for things more, are more worried, more concerned about share, want to understand more about it. And they do that by going back to the most basic source they can find, a sort of profile of the company on Wikipedia. And they do that in their droves, including investment professionals who work on Wall Street. That happens in the immediate preceding weeks before a share price does decrease. So what did my research look at? How could we bring this Google Trends data into credit risk modeling, and how could that help us understand larger companies as well as SMEs? Now, the premise of my argument was that people search for things on the internet before they happen, and therefore Google's advertising price for particular keywords to get a search result high in the rankings, how much you have to pay for that, as well as the volume of searches themselves, would be econometric data that Google have, which we could access to build into the model. I chose to use only the Google Trends. Anticipating what people were going to do via that data, how much they were going to spend, could be achieved by analyzing what people were searching for, and that could help you predict business to business and as well as consumer spending in the coming weeks, months, years, depending on the lead time of any one industry. Predicting how much people are going to spend in the cinema this month or this week might be easier to predict on a shorter term basis than a longer term basis. Predicting how much people are going to spend on cars or houses might be a longer term purchase, and therefore the lead time of search to economic activity might be longer. But machine learning maybe could decipher those timeframes and those lead times from the different data sets of financial performance and search data, and therefore we've been able to anticipate corporate revenues. Corporate revenues are of course reflected in the financial statements, which we then use traditionally for ratio and other analysis. And then that helps a company understand how well it's done, where it wants to improve performance, and it might then decide on its advertising budget based on its last year's financial statements, which would therefore feed into the Google econometrics, how much it's advertising on those platforms and other places, which will influence the number of searches, which would influence the spending. And so this pattern would repeat, and AI applied to all these data sets could help us understand the economy and anticipate the next step in the cycle when we've got a previous data set. But the question is, what data did I have access to? Well, really only public data from Google's search history trends and the corporate financial statements that we'd always used with the two data sets. And so I tried to think, could we leapfrog those other steps in that sales performance cycle of a company to take the idea of, can we anticipate the financial performance and therefore the credit risk from those Google search trends? And would piecing those two together in a machine learning model improve the accuracy of anticipating that corporate credit risk, either in the immediate terms of 1 year, 2 years from default, or maybe on the longer term, 5 years away from default? So to do this analysis, I had to build a baseline model, and I did that using all the best qualitative and quantitative techniques, including that trend analysis from previous studies, and built that model using machine learning. So I took 5 sectors worth of company data in the UK, 220,000 companies with their history over a 10-year period. Use machine learning to analyze that and anticipate the potential for default. And I also included meta variables, so things like percentage change in particular financial metrics, as well as ratios that we used across all of the surveyed studies that I had. And so there were sort of 12 ratios that were common across all the studies, although, as I said earlier, one study tended to use 4 or 5 ratios that could represent the picture of a company. I had to adjust, lots of companies file non-annual financials, so we had to adjust for those and compensate for that in the model. And you also have to think very carefully about when financial statements are filed. If a company goes bust, then often the financials are published up to 9 months after the year end, in which case it could be the financials are published after they've gone bust. And an accountant publishing financial statements for a company that's gone bust is going to massively edit and change both their narrative as auditors potentially, as well as the way that those accounts may appear, knowing that they do at that time that the company's already gone bust. So you have to sort of remove the bias from the data and the model that gives you an over-accurate prediction of companies gone bust from using the last set of financials before they've gone bust, because often those are published after they've already gone bust, and so they're written with the benefit of hindsight. So you normally have to eliminate that last year of financials from the model in order to make sure that you're not having an over-accurate model produced on retrospective data. And I also built in a factor of sector level default, which helps give you a sort of macro indicator for any one sector of the performance of companies. And that over time is a useful data point to build into the model, as well as company specific data. And I defined failure, as Edward Altman did, as an event of liquidation, administration, or other bankruptcy filing. And this is what I was able to achieve with the base level of machine learning. Bear in mind here that Ed Altman studies on people who've been 85, 90% accurate. This is what I was able to achieve using that scale of data. So 94% accuracy, 1 year away from default, the similar performance 2 years away from default, and 81% accurate 5 years away from default. So the scale of data and the power of machine learning was able to give me the effect of building a very accurate model very quickly. Now, we're going to just talk about the 6 most influential factors on a univariate analysis basis that occurred in that machine learning model that I built. But before we do, I'd just like you to have a go at this poll where we're going to ask you, which financial and non-financial metric do you think was the most important in the model to predict the potential for default? So things like assets or turnover or a particular ratio or a particular non-financial metric. What do you think was the most important factor in the model? This is free format here, so we're just going to see whatever you type. So please feel free to have a guess at what you think was the most significant factor that the machine learning decided in my model was how to predict failure in a company. Turnover, market sentiments, leverage ratio, acid test. So we're talking about whether or not a business has got cash, liquidity, management, assets. CFAD, so that's cash available for debt, profitability ratio, solvency ratio, liquidity, profit and loss, solvency. Okay, so people tending to be focusing on the management or on liquidity, number of customers, debt coverage, yeah, market sentiment. So those are all important things and things that have been used traditionally, and liquidity, you know, cash is king and so on. And this tends to be something that people think to be very important, as well as management team. In fact, the number one factor in the UK from the data set that is available from Companies House was a missed financial filing. So before an event of default, a management team, and this, you know, maybe one of the things people were getting at with management team as their answer, before you went into default, the management team might be distracted, and the annual filings at Companies House that you have to do just on your business and who owns it and who's involved in it, as well as filing your financials. If you missed one of those or you did it late, that was the biggest correlation with then subsequently failing. And it's just because, you know, your priorities are changing as the business maybe isn't performing as well, and that was very, very highly correlated with failure in the shorter term. Weirdly, the second most influential factor was another filing event. So if you had a change of name or a change of location, or you changed the stock of your company and who owned it, or indeed you had a more major management change, this was a very important factor in failure, because people tend to restructure or tend to be changing things as things are going worse in a company, and they're anticipating the fact that things might fail. Third, and I think it's interesting that we, you know, haven't got any financial metrics or any cash metrics yet coming out in the model as the most important factors. The third was the number of employees. And I think given that I included SMEs as well as larger corporates, this is really a proxy for size. And so the machine learning model was saying that size is an important factor in anticipating default, and obviously smaller companies are more likely to go bust. The fourth most important factor was elongated reporting. SIC codes, the industry with which the company was belonged, and bear in mind I only included 5 sectors, was very important, and that was correlated with accurately predicting failure. And then sixth most important factor was total assets. And so only in the 6th place, the most important factor in the model was a financial metric coming in. So I'm going to give you what I did, which was add those keyword searches to my baseline model. Which keywords was very difficult to determine. In the end, I used 35,000 words that described the industry, words that described general human sentiment, so whether or not people were happy, and general economic related keywords. And I built all that history in, and then let the machine learning decide over 14 years, matching the history of company data that I had, which were important, as well as the significance to the model. I took my baseline model and then added this new Google search data as an offset to help create a more accurate model. And this was the effect on the results. Out of the 5 sectors, 2 increased in accuracy, in their predictive ability, and those went from 94% to 97% accurate, which is incredibly accurate in the history of academic performances in these models. 2 were flat, they saw no increase, and 1 actually decreased in accuracy, the one that had the least data, the fewest number of companies in it. However, all models increased in their validity and reliability, even though their predictive accuracy didn't all increase. And so therefore, there must be powerful predictive results data, and signal within that stream of 35,000 keywords and their history over time. The relatively small sample in certain sectors did damage the ability of the model. Interestingly, no one keyword for a particular industry stood out as an important factor. So it's the general trend of the overall search terms of words. But I was trying to deal with this problem all the time, that we've got annual company filing data where we've got monthly Google Trends. And so that is something that one has to overcome. And it would, of course, be bettered by having monthly financial data available from companies. And with alternative data sources, that's something that's now becoming available. Now, most models, this is true for banks as well as academic studies, most models that are trying to predict failure of companies now use macro effects in the model to anticipate the performance of companies and help in overall influence. And so predicting GDP as well as the performance of an industry at large is a useful thing to do. So I also tried to do this and use the same technique, used previous quarter's GDP filings in the UK and tried to anticipate the next quarter. And using normal linear regression techniques, you're able to do that reasonably accurately. However, adding in keyword history from Google helps improve the accuracy of this model on a regression basis very significantly. You can see the results of that on screen. But I only added 2 keywords. I added the search history for the words debt and the search history for the words government. And people's sentiments were reflected in those keywords. And you can imagine what they're thinking and feeling when they search for those words on Google. But the trends for those 2 histories, along with the history of GDP itself, was able to improve the accuracy of predicting that. And then I was able to feed that in to my company model and have the effects of that accurate prediction of GDP for the future, as well as Google Trends for companies in particular keywords, particular products, related to particular industries, related to economic sentiment at large. I also took, as I said, the 50 most popular words in English that are used more generally, just in the English language, added the search history of those in, and put them all into one hybrid model, which I think in the end game will perform the best. And so we could then extrapolate this model. I didn't do this, but it would be possible to imagine that you could predict individual financial metrics on an annual basis into the future. And perhaps more than an annual basis, you'd be able to also, with monthly data, predict them accurately on a month-by-month data, which might help in cash flow lending to SMEs, which tends to be done on a shorter-term basis, anticipating working capital needs in next quarter, rather than year on year on year. So, online searches is an alternative data source which can be used and can be built into credit risk modeling to improve its accuracy. But what about sales pipeline of a business? If you could anticipate how searches would translate into a pipeline and how that business might perform in the shorter term. If the business is one that does quotes for jobs, could you get access to that data? Could that help you anticipate their credit risk performance in future? If you had their live sales data or maybe their contracts that they were signing and see and get a picture of that, could that help predict the accuracy? And you can see here how we're moving through the sales cycle of a business, getting towards taking the money and making a sale, which we then see reflected in the financial statements. The invoices, those that are being issued, if you could see invoice data, would that help? Payment data on payments platforms as people receive maybe credit card and debit card in retail-facing industries, or on PayPal online, if we could see that data, would that help us build more accurate credit risk models, understand businesses' cash flow? You then see those invoices and those payments as they occur translate into bank statements, which begin to be less live now and sort of backward looking. And then obviously the events of the bank statements are recorded in aggregate, and the financial statements, which we've always traditionally used for ratio analysis and credit risk modeling. So you can see from this that as we move through a business's sales cycle, there's different data with different sources that could help us build credit risk models. And if we haven't got financial statements, or if we haven't got bank statements, but maybe we have got public data like online searches, we could use alternative services that represent the middle of that sales pipeline, which could give us a picture of what has gone into the pipeline and been funneled through to make a sale. And therefore, if we didn't have financial statements, we could use invoices or payments to perhaps build a picture of a company's performance in spite of that. And that's really what alternative data is about. When things like open banking maybe don't exist or financial statements don't exist, you can use alternative sources in the middle. To conclude, I'm just going to give you examples here. So online searches could be Google Trends. Sales pipeline could be data from a CRM, customer relationship management system of a business. Quoting could be done on that system or a pre-order system. There's ERP systems or marketplaces. Amazon data could be a source, and indeed they are using it to lend to small businesses, anticipating the business's performance and cash flow off the product searches, the clicks onto particular products, and then the sales that they see. There are ERP systems like TradeShift that are digitizing global trade, and access to that data could help banks lend into global trade in a way that they haven't been able to do before, particularly for SMEs. Invoices and invoicing platforms, ERP systems, are beginning to open up data to allow the banks to access that, to understand what's about to happen as a sale or about to be collected as an invoice, and obviously could help digitize working capital. Payments platforms like WePay, like Alipay in the Asian markets, like PayPal in the UK, Europe and America, have begun to do lending, and payments platform data can be very crucially important in anticipating cash flow. And obviously open banking in Europe, in the UK and in other parts of the world is now making accessible bank statements and the data from banking in a way that hasn't been possible before. And cloud accounting gives us access to their financial statements in a live way that could give us that monthly data that could help compare to live Google Trends or live sales data. So my study looked at one aspect of alternative data, but there are many aspects of alternative data that we could bring in. And at that point, well, I'll conclude my presentation and move into questions.
Thank you. Right, well, thank you, Jonathan. That was extremely insightful, and I think you covered a lot of territory or ground during that presentation. We've had a couple of questions already. If anyone else has any other questions, please just type them in the chat box, and we can add those in as well. Firstly, also, I wanted to thank everybody again for joining us today. It's fantastic to see so many people with a real interest in this area, and in particular, so many from an international perspective as well, many from across Asia, and even I noticed someone from America, which is either a very late night or a very early start, depending on how you view it. Just to kind of start in terms of the questions, Jonathan, I'm just really interested to hear a little bit about what Santander is doing in this whole area in terms of using alternative data. So maybe you could, at the end there, you gave us a bit of a look into the future. Can you just give us a bit of a sense where Santander is on that kind of evolution?
Yeah, so we're fortunate in the UK to have open banking, which means that, both with accessing accounting data directly and on a more regular basis, and particularly for SMEs, that more regular, that more granular monthly data is very important to be able to do more cash flow lending when you're not doing term or scale lending like you might be doing for a larger business. And that, coupled with the validity that you can give that accounting data from open banking data and pairing those two together, we think is the most powerful data set that can help automate and speed up SME lending, which is also a particular factor in using alternative data that it perhaps is more live, is more granular, and can be used on a continuous basis to iterate and give an SME the impromptu finance that it might need for this quarter's sales, to deal with an event like COVID-19, to deal with the opportunity that occurs when a business shuts down next door and suddenly they want to expand their premises, which weren't able to be anticipated.
Great, thank you. So I think if I kind of just building on that a little bit, in what ways, as I mentioned at the start about this whole the COVID-19 acting as a bit of a catalyst for digitalization across the economy, both for banking, but really for all sectors. In what ways do you feel that the digitalization, and again, this is a global phenomenon, will act as a catalyst in terms of the evolution and growth of alternative data models?
Yeah, so I think as perhaps transactions become more remote, cash is used potentially less, and we're dealing with each other online more, the data and the amount of economic activity that's going through payments platforms, marketplaces is going to increase, and therefore the anticipation, the accuracy with which one can sort of know what's going on in an economy and industry for any one particular product will increase. You've seen a change in the last 5 years where 80% of product searches used to start on Google. Now 70% of them start on Amazon. And so Amazon can have a real good sense of what's going to be sold just by searches that are going on that platform. And then clicks from those searches into particular products help anticipate particular product sales. And then the businesses that are selling those products obviously can get a good view of their sales performance and the anticipation of that from that data, as well as then what's actually sold on the marketplace. And so as people are doing that more rather than browsing in shops or interacting face-to-face, the wealth of data and the percentage of the population, the percentage of economic activity going through those sorts of platforms, marketplaces or payment platforms will increase, and therefore it will only become more accurate and more
Great.
Data.
So one of the questions that's come in is really, obviously, as I mentioned, we've got many participants from different parts of the world. As we know, in the world of banking and finance, different countries are at a different stage in terms of their whole digitalization, the way they provide banking services. From your perspective, how do you see that kind of evolution? Is this now going to be a rapid adoption of alternative data models, or is this something that will take quite a lot of time to really kind of work its way through the system and through different countries?
Yeah. So I'd say payments is probably the main context here, in that just like where countries have had maybe less established debit and credit card payment networks or less established local clearing for payments, they've tended to then jump banking payment solutions, or indeed payment schemes and card payment schemes, payment solutions, and move straight into mobile-based payment solutions, and whether that's QR codes based, or like WePay and Alipay in China, or maybe even face recognition now, or mobile pay payment solutions that exist in Ghana and Kenya and many other parts of Africa. Google Pay has been tremendously successful in India. People have jumped to those digital and mobile payment solutions, and those have then created marketplaces around those payment solutions. They've had huge amounts of data. People have started holding bank accounts on their phones, and not even necessarily opening an actual bank account with an actual bank, but holding balances in e-wallet solutions. And that data and the lack of payments infrastructure means that sort of alternative data in those markets, because it's coming from these mobile or other technology providers, is far more significant than traditional, say, data sources or banking sources. And so I think there's emerging markets, you're going to see a reliance on the alternative data far more, because those technology and mobile providers, those payment providers, have got far more data, and they've also helped democratize access to banking in a way that traditional banks in those markets haven't been able to reach.
Yeah, so that's a really important point, isn't it? About because you mentioned at the start about this funding gap for SMEs, and one would anticipate that this is going to become ever more of an issue, and probably a very high-profile issue, I suspect, as we look to kind of recovery plans out of the COVID-19. So how do you see that kind of playing out, really?
Yeah, so I think accessing live data from those systems in those markets where they're dominant, in more established Western markets where perhaps those alternative payment mechanisms aren't so crucial, but data being accessed from card payment schemes, from live cloud accounting package, from open banking, will help. give you that immediate picture of an SME, what they've been doing this week, last week, last month, and therefore be able to anticipate next month. And as we're perhaps less able to predict the long-term trends and we have to take things month by month, I think those data points would be very useful in anticipating the needs of SMEs and helping meet them, particularly as I say, cash flow is perhaps more volatile than it once was, even for smaller businesses, where, as I say, it's inherently more volatile than it is for larger businesses.
Right. Okay. I'm mindful that we're nearly out of time, but it's fantastic to see so many questions coming flooding in, if I may. And maybe we can look at a kind of forum or something to follow up on some other questions which we haven't had time to answer. As I mentioned at the outset, this is the start of a series, so we will be having other webinars as well. Have you just a question there about, I think obviously a lot of, the adoption of mobile phones is one of the things that pretty much has got global phenomenon, isn't it, really, and smartphones for that. Have you used mobile phone traffic as a variable? Is that something, or different ways we can use that mobile data?
So I didn't, in my research, say it was just Google search history trends, which obviously can be from mobile or from desktop internet access. But yeah, where people are, social media activity, what adverts they're looking at, what they're clicking on, what they're searching for, what they follow, anything that gives you an insight and an indication into what economic activity people are going to do, what they're going to buy, what they're going to spend, how they feel about their job, how they feel about the economy at large. Whether or not they're happy or sad, these things affect whether or not certain economic activities are going to take place. In recessions, takeaways and alcohol do well, chocolate does well, and you probably see those trends play out. And so I try to look at how to understand people's moods, particular sectors, people's desires, people's thoughts, people's feelings, in taking into account different keywords. But these things are reflected in different ways in different platforms, but they give you a different lead time, as discussed for different industries, for different products, but they can all be fed in to give you an indicator. But the volume of this data, including perhaps where people are, which could be tracked by mobile phone, is so large that it really takes the power of machine learning to assimilate that or use it live and anticipate what consequences we can draw from it because of precedent that's been set in the past. Even if we're extrapolating that out into a larger scale event, perhaps then the scale of that particular technology or particular product might have been adopted at.
Sure. So there we are. So 1 second. So one of the other comments that is often made is that data is the new currency, and that presents lots of challenges, I guess, for banks and all sorts of regulators as well. So how can we ensure a kind of fair marketplace, which is one that's kind of makes it easy for businesses, but at the same time is appropriate, because maybe there are concerns about organizations like Amazon almost having too much information. How can we kind of rebalance things?
Yeah, it's a very interesting question. Data is incredibly powerful. Obviously, open banking and PSD2 across Europe has been a method by which people are trying to democratize the access to data about a company and its transactions and its interest rates and the products and borrowing that it has, the savings that it has, and hopefully make that landscape more competitive as a result. But it's not just banks or fintechs who can access that banking data. Anyone can if they've got the right licensing and ability, or they partner with someone who has. And I think it's going to be interesting how the pressure might begin to exist on other industries or people who've got large-scale data and effective monopolies in particular markets. How the pressure might come on them to help clear up their data and give access to it and make it democratized and put it out there in the way that Google do with Google Trends. So Google don't have to do that, but it helps feed their advertising business in some respects. They keep some of that data back. How often particular adverts are clicked on, they don't share, for example, but they do at least give you a decent picture into what's going on their platform. So I think it may well be that PSD2 data sharing type activity would then take place in other industries, mobile phones, marketplaces.
So one final question, because we are really out of time. What is include? Just to go back to your final slide, I think there was just one or two of the participants we just wanted to clarify. Are we talking here about alternative data and how you see the kind of some of the key aspects really that will enable better information?
Yeah. So if we take the right-hand side of the diagram, cloud accounting being financial statements, that's traditional sources, say, used for more than 50 years in ratio analysis. More than 100 years from the first study. And bank statements being a sort of traditional source alongside accounting data, those are the right-hand side. Now, there's new ways to access those data sources, open banking and cloud accounting. But if you can't get hold of those data sets, or maybe, let's say, people don't have bank accounts and bank relationships in emerging markets, or there aren't the strength of accounting standards or auditing or filing requirements that there are in some markets, then the other things as we move left give you a good representation of what happens on the right. And those are less traditional methods. As I say, they haven't been studied in academic papers in the way that accounting and financial ratios have been, but they could still give you a picture. So data from payments platforms, data from marketplaces, data from ERP systems, all these things could be used to understand a business's performance, cash flow, their expenses, their sales, their anticipated sales, their cash collection cycles, and so on. You could get data from those things, and you could use that instead, or in addition to getting data from the more traditional sources on the right-hand side. My study was trying to join the earliest phase of a sales cycle, Google Trends and search history, with that right-hand side, and putting those two data sources together to improve the accuracy of credit risk modeling. And that's because in the UK, getting access to these middle data sets is harder because, let's say, payment platforms are dominated by the card schemes and the card payment platforms, and obviously they don't want to share that data with their competitors. Whereas in Asian markets, WePay and Alipay have been able to make either lending off their own data available or share more data from those platforms, because they want to encourage other products and services to be offered on those platforms.
Right. Okay, well, thank you, Jonathan. And we now need to kind of, I think, just wrap up the session. But it's been fantastic to see so many good questions coming in and such an interest in this whole area. And again, I just want to finish by thanking Jonathan for such an excellent presentation, which has really stimulated a debate and interest in this whole area. So thanks, everybody. Bye-bye.